from the stock market perspective. So LPL is pretty bullish on stocks, right? LPL thinks that the S&P fair value will be, 5,000 to maybe 5,100. It's 4,700 today. It started the year at almost 4,800. It was like 4,776. So we're down a little bit already, but from 4,800 to 5,000 is not big growth, right? That's only about 4% growth in the market. I like this, and I believe it. I think that that's about a pretty good estimate of where the stock market can end up for this year. And I like that. Again, that to me is very Goldilocks zone. When people say, so again, I'm getting in the weeds a little bit more than usual, but when people say the stock market's overvalued by 20%, right? What in the world does that even mean? What they're saying is that the PE ratio, so again, it's not that confusing, so I'll take a second to explain it. PE is price to earnings. I've been talking about it a ton lately. So you take the price of a stock and you divide it by the earnings per share or the profit, right? And you get the PE ratio. So the PE ratio right now is like 21 to 25. Historically, it's closer to 15 or 16. So when people say the market's overvalued 20%, what they're saying is if the market dropped 20%, the P, right, price of the stock dropped 20%, and then you did a new PE and you divided price by the earnings per share, you would get closer to 15, 16, or 17. And that is considered more fair value. And that means we'd have to have the stock market drop 20% to get there. And that is certainly one path. And I think if interest rates go way up fast instead of up more slowly over the next couple of years, I think that will happen. So I don't mean to freak everyone out, but I'll say that again. I think if we're not in the Goldilocks zone and wages keep going up, supply chain is all messed up, inflation goes through the roof as a result of those things, and as a result of that, the Fed pulls back on their quantitative easing as well as raises rates, and the 10-year Treasury goes up, from there, let's say above, like we'll talk about bonds in a second, but much above 2.75 or 3, I think the market could drop 20% to get back to what's considered a fair value. That's what we have to avoid, and those are the things we're watching for. But if the market, let's say, we've had a lot of earnings growth. If earnings grow, let's say 10% this year, which is incredibly realistic. I mean, GM sold hundreds of thousands of less cars than they did the year before and made 20% more money, in 2021. So that's good for them, and it's good for the growth of earnings. Again, I'm not sure that it's great for inflation or interest rates, but it's good for earnings growth. If we're overvalued by 20%, right, which is probably about right, and the earnings go up 10%, but the stock market only goes up 4%, right? We just fixed 6% of that 20% difference that we're talking about, right? I'll say that again. If earnings go up 10, but the stock market only goes up 4, that price to earnings difference, where we're at 21 now, and we think 15 to 17 is probably more reasonable in a long-term average, we just ate away 6% of that. So now instead of the market being overvalued 20%, it's only overvalued 14, right? Because the E went up a lot and the P only went up a little bit, right? So the price to earnings ratio went down that year. If we could, again, that's the tightrope. I think if we could do that, where bond interest rates are going up slowly, inflation is like 3, for the year, like LPL thinks it'll be 3.7. I'd be content with that as well. So inflation's up, 3, 3.5. The 10-year Treasury goes up a little bit. We'll talk about that in a second with bonds. The P goes up, right? The price goes up maybe 4 or 5%, but the earnings go up 10. Now we're kind of on our way back to a more normalized price to earnings. So that is what I think we all kind of need to watch for, and what we are watching for very closely. I think what's interesting is that crazy? Like, is a 5% growth as we're kind of transitioning to mid-cycle, is that crazy or is that reasonable? So what this chart shows is that it's pretty reasonable. So in the year that you can kind of go back and figure out, okay, in years where you've gone from growth to mid-cycle, what have the gains been? And so the S&P 500, first of all, rose in mid-cycle economies. So again, that transition and then a couple of years in mid-cycle, the S&P was up 80% of the time. So mid-cycle is not bad. It's not a recession. It's just slower than the rebound from a recession. And the average is 11.5%. Well, that is not going to happen in my opinion. So for anyone looking at this saying, oh, great, we can earn 11.5, you won't. Because if the market's up 11.5, that means inflation is through the roof. And that means you might get a little bit of that 11.5, but then we're going to have to stop and interest rates are going to go through the roof and it's going to slam the brakes on the economy. So I actually don't want anywhere near 11.5 this year. I think it'd be way too high. But 80% of the time the market's up. And, you could see a lot of the time it's up a lot. All of these blue numbers are up more than 5%. I would love to see a couple of years of maybe here, at maybe that 4 to 5% growth rate. It's kind of on the upper end of this yellow. And again, there's not a lot of big recession years. A couple of the 70s, 70s were a terrible time. 2008, that was you were kind of moving to, you were in the mid cycle and you had that big recession. But really, other than that, you don't have a lot of like these huge, gigantic declines. I think a lot of people are worried that, the stock market's going to go down 20, 30, 40%. We actually had somebody the other day, we did some small, like for the first time ever, we're starting to do actually advertising. And someone booked an appointment with us and said, I think the stock market's going to go down 80% by the 12th. Can you help me before then? We're like, no. It was just, it seemed like a ridiculous request, but the person was very, very serious. And a lot of people, I think, are worried about that. If you look, this is +5 to -15. There's not a lot of huge recessions in those years. And there's a lot of years that, in this mid cycle that have done just fine. Again, I would hope we're on the upper end of this yellow. But I think as an estimate, or as a hypothesis of where we might be, this shows that we would kind of be right in the middle of that bell curve, actually on the smaller side. So it should be hopefully relatively easy to get to. This graph, I think, is nice. It shows how well we are expecting the Fed to increase rates. How well has the market done before we raise rates? I think it's done fine. And then here, I think that from a stock perspective, it's all about earnings. So it's all about, are the companies making money? 2019 was a very profitable year, right? Trump tax cuts on the corporate side, stock market was up like 25, 27%, right? It's a huge year. Companies were super profitable because they weren't paying taxes and the economy was good. It was very, very profitable. But look where we're at now. We were at $163 of earnings, that's profitability per share of stock in the entire S&P 500. It went down, of course, in the COVID year. It rebounded drastically. And I think nobody thought we were going to have this big of an increase. But this year, if you remember a couple slides ago, LPL is estimating that we're going to be at 235. So when a lot of people see that the stock market is super high, it is. But when you buy a stock, what do you buy? When I ask people, like, what do you buy when you buy a stock? They say a share of a company. That's true. That's factually accurate. But in addition to being a share of a company, I would go a little bit more granular maybe than that and say you're buying a piece of the cash flow that company is generating, right? Part of their profit you own, which is going to drive that little piece of the company that you own up or down as the earnings go up and down, right? So the earnings per share is what you're really buying. You're buying that cash flow when you buy a stock. So yes, the stock market is high, but if earnings end up at $230, $235, look what a huge difference that was even just from 2019, which was already high. So if companies are that profitable, they can support a lot of the stock market. And again, that's where if we can be in a Goldilocks zone, which I don't think is unreasonable, if we can be in a Goldilocks zone where interest rates go up a little bit, inflation's 3.5, 3, 4, 3.5, somewhere in there. The government's, telegraphs, which they do very well now. The Fed is kind of telegraphing, here's what's going to happen with interest rates. Here's what's going to happen with kind of removing the quantitative easing, which is all the stimulus that they did for COVID. And they start removing that at a measured pace. It's not too fast. They raise rates as a measured pace. They tell us about it. This companies make a little bit more money this year, which, again, 10% is not unreasonable. 8% is about an average. You could easily see the stock market be fine. And I think most people, and I'll speak for myself in my own portfolio, if after the portfolio gains we've seen in the last 2 years, if I don't get a gigantic recession, if my portfolio went up 4% this year in the stock portion, I'd be ecstatic, right? Because the last couple of years have been so good. I just don't want to give those gains back, right? But I don't necessarily need another 20 or 30% year to be a happy person, right? I would be happy to keep what I have and see some slow growth there. So we'll see where the earnings per share goes, but they're big, which supports a big expensive stock market.